Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso, and today we are beginning part 2 of our interview with Todd Langford. Anthony, what's the takeaway you had here?
There was a bunch. I mean, and that's why we broke it up into two parts because there's so many. And I was taking notes on when he dropped some wisdom.
Mm-hmm.
And man, I don't think I've ever made so many notes. And I don't take a lot of notes, so that says a lot. But a couple of highlights that I had from this one is we kind of talked to him about some of the questions when people are evaluating whole life and they're comparing it to another asset. And one thing he talks about, when people say, "Oh, whole life is terrible," or whatever they say about it, it's compared to what, which I think is a great analogy because really a lot of the times what we're doing infinite banking for investors, so they got to store the money somewhere.
Mm-hmm.
So when they're looking at whole life compared to what would be, well, where else are you going to store the money? And so it's really comparing whole life not to an investment, not to a 401k, but to where you're storing the money, aka a bank account. So that compared to what was one of them. And then he also talks about with whole life and with insurance, we're using actuarial science. So there's no deals in life insurance, right? And we're just using actuarial science. So to me, that was a big help.
Mm-hmm.
And you're looking at me. Turn over to you.
I am, yeah. I didn't know if you're
What were
done.
some of your takeaways, Cam?
Well, thank you, Anthony. Wow, thank you for
You're
asking.
welcome.
Yeah. If anybody's listened to our podcast, there's one thing I dislike more than Anthony Faso.
Is what?
It's IULs.
Oh,
Exactly. So we posted that question to Todd. We've asked him before, but he gave us a different perspective. And one of the things that he shared with us was this idea of insurance and what the definition of his insure is. He said insure is to guarantee an outcome. And I really appreciated that is because when you look at whole life insurance and the back end of this product, what it looks like is it's very safe, very secure, very predictable. But when you look at the back end of a UL policy, it is as uncertain and fragile as could be. And so I appreciate that perspective, kind of above and beyond the numbers that we typically look at or typically share. So hope you guys episode.
one thing I don't think we said in part one or part two
Hmm.
is that one thing we like to say is that we do the math.
Yeah.
Like we're analyze things that we're saying or comparing different strategies and looking at the numbers. One of the key tools we're using to do the math is calculators that Todd has created
Mm-hmm.
called Truth Concepts. So if you go through the process with us, and one thing we do is comparing buying an asset with cash or buying it through a policy. That the amazing calculator we're using is created by Todd Langford.
Mm-hmm. Todd's a great guy, great knowledge, great resource for us. So again, we just wrapped up our interview. Want to click on that for me? Hope you guys enjoy this episode. Todd Langford, he's the creator and founder of True Concepts Financial Calculators. His love for numbers and desire for integrity in the financial space inspired him to create calculators that would cut the pretense and get straight to the truth. Hope you guys enjoy this episode.
Take care.
Welcome to the Infinite Wealth Podcast, where we teach clients how to build wealth and create passive income without the risk of Wall Street.
Todd, the idea that I had earlier was we meet clients kind of face to face, and what you had touched on a minute ago is just kind of talking about some of the way that clients view their financial investments and those things. What I found is it's very short-sighted, and the example that came up was that I was talking to somebody the other day, and we looked at it kind of one strategy versus another. In about 10 years, they were about even. And the client was like, well, this is crazy. Why would I ever do it? And then we extended that out to 30 years, and there was well over $1 million difference between the two strategies, right? And so I think part of the education that we give clients is have a much longer, broader perspective on it. But my question, right, is I know that you deal with a lot of advisors, and a lot of advisors are kind of approaching truth concepts and getting exposed to some of this these ideas and truths a little bit differently. What's been your experience with the way that some of the advisors, maybe from the investment side, have kind of embraced or not embraced some of the teachings that you've had over the years?
Well, it's an interesting question because as humans, we don't want to be wrong.
Yeah.
We don't.
Especially CPAs. Yeah. We do not want to be wrong.
They're always wrong, aren't they?
The zing. All right.
Yeah.
You got a zinger against me, but remember, that's only half a point. But okay.
No, but nobody wants to be wrong. And yet what we have, if you really want to get to the truth, debate's going to have to happen, right? And it's going to have to be friendly debate, not the kind of debate that we see this day and time.
Yeah.
People used to be able to come together and actually debate to try to get to the truth. Instead, now it becomes name calling and cancel culture and that kind of thing when we start to talk differences. And so, I think even in a lot of ways, I think looking at like from a political standpoint, Republicans and Democrats, I think ultimately we kind of want the same thing. We just have a different way of going about it. And yet it's become this abrasive difference that we're never going to get to the truth over, right?
Yeah.
And so as advisors, we have to be careful with our clients, understand nobody wants to be wrong. And I'm going to argue my position with emotion because that's who I am, right? But that doesn't necessarily make me right in every scenario. If I just said I'm right and I'm not going to listen to anything you have to say, we're never going to grow. We're never going to find absolute truths, right? I'm still, as long as I've been doing this, I still learn new cool things in the financial world that maybe somebody didn't think about from a new strategy or those kind of things. And so we have to be open to listen to them. And I think that every decision is an emotional decision, right? Ultimately, it's not a mathematical decision, but I think the math can help demonstrate and help us get an emotion around that decision and understanding where the truth is. So going back to the question you actually asked, sometimes it works well. And I know somebody who's truly seeking the best for their client. And that is the person that says in class, and it's always fun for me, man, I've been told this 30 years and you just proved to me that it wasn't correct. And I'm going to have to change what I've been doing and what I've been saying to my clients to get it correct. That is somebody who really is seeking the truth because they're going against what they've told. They've admitted they were wrong. That is a hard thing to do. And I think that is the culture that we're creating. And that is so much fun for me to see people embrace that.
Todd, you'd mentioned that when you do have an argument or discussion that you do it with emotion. But I've seen you speak multiple times. I've been to your training. I've seen the videos. It's very logical. I'm telling you, next time I see you in person, I'm going to create an argument, and I want to see Todd, the emotion Langford. I want to see that
cool.
side.
I can say all kinds of nasty jokes about CPAs and everything else. We can
yeah. Don't hold back today, Todd.
All right,
Fire away.
Give you another one there.
Yeah. Speaking of kind of traditional mindset is changing. Here's a topic we talked about recently on our podcast. I was going to throw it to you and get some feedback here. Is the idea that for someone to be successful, they got to take on more risk to return to get a higher reward. What are your thoughts on that model?
That to me, so I think if we break it down and we understand the pieces. So first off, what is the definition of risk? And I think this is where some of that got out there. I think most people look at risk as the likelihood I'm going to hit one out of the park. That is not the definition of risk. Go look it up. It is the likelihood of loss. Okay. So if we look at it in that context, what people are literally saying is I have to increase my likelihood of total loss so I can have a higher return. Now, in what galaxy does that work? That is the craziest idea ever. Okay. And it opens the door, but I think what is the rule? When you say a lie 7 times, it becomes truth. And that,
yeah.
And that's where that comes from. It's right in there with the idea that you're going to be in a lower tax bracket when you retire. Right.
I'm with you
Where
on
does
that.
that where does that come from? Okay, so what determines your tax bracket? How much money you make. Right. So what you're saying is you're looking forward to having less money than you do now, so you can be in a lower tax bracket. That is not something to look forward to.
No, absolutely not. But I think it's just the bluntness of the questions and the way that you kind of rearrange those questions when you ask them that people have accepted a lot of the truth for a long time, right? And so we got to break through and kind of knock them on the head a few times and say, "Hey, here's what this actually means," right? So, great question. Yeah.
Well, I think part of it is you can't know everything there is to know, right?
Hmm.
You rely on other people to give you some of that information. And if that information confirms and helps you get to where you want to be, in other words, this idea of like being in a lower tax bracket or high risk and high reward, both of those ideas, it's like, oh, I can take on some risk. Okay, well, good. They said that that would work out. And so they don't investigate it all the way out because they've got other things that they do, other things they do well. They rely on somebody else. And so when somebody just says that, it's easy to accept it if it fits their plan or makes their plan work out better in their mind. Does that make sense?
Hmm.
Now, Todd, a lot of times when people first hear about IBC, and this was my reaction, this sounds too good to be true. What do you say when somebody says that?
I really don't like that because everything of value was too good to be true the moment before it was created. Or I think it's Peter Diamandis that says every idea is a crazy idea the moment before it becomes reality. Right.
Mm.
And so my point in that is it, it it is a crazy idea. A lot of things are, and this one in particular. But and so I think it means we need to look deeper into it, not just dismiss it. This idea of just dismissing something, say, hey, if it looks too good to be true, it is, and go on to something else. We're going to miss out on any new innovation, anything that's coming along, anything that we haven't heard of. And I think in some ways, it's almost a little ego centered. If you say, well, I've never heard of this, so it must be crazy. It must not
Mm.
be true. Oh, really? You've heard of everything, huh? Right? And so we need to be open to looking at things, but we need to be smart too, right? We need to investigate it deeper. We need to see the math behind it. We need to look at all those pieces and not just immediately dismiss something because it didn't fit into our box of what we've heard in the past. And really, if we knew everything, then why would we need to ask advice from anybody?
Yeah.
Mm.
Speaking of kind of asking advice or just asking questions, I used one of your lines most recently. I think it was maybe a week ago or less. But we had put some policies in place, right, for a young man out in California. And I got an email kind of out of the blue that said, "Hey, Cameron, I want to cancel my policies." I said, "We can do whatever you need to do, right? Let's discuss." So we jumped on a call, and I go through this, and he starts looking at it, and he's like, "I'm not happy with blah 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 blah," right? And I used one of your lines, which was compared to what? Like, what are you
Well,
comparing this to?
that's from Daniel Pink, so I don't want to take
Okay,
credit for that, but yes.
awesome. But I asked him that, and he goes, "Great point." Right? And I go, if you don't put it in here, where else are you going to put the money? And he's like, probably a savings account, checking account, right? And so we had this discussion just on kind of the opportunity, and we go into opportunity cost and review some of the ideas that we discussed. But man, right, that's one of the sentiments that I've used many, many times over the years. So thank you, and maybe tell listeners a little bit about where you got that.
Yeah, that's awesome because that line came from Daniel Pink, but I think it's so important when we're talking about a life insurance policy. Life insurance policy really isn't an investment, right? It's a savings vehicle, and it needs to be kept in its own class. And what people want to do is compare, you know, a return. What if I put this in this special real estate deal and I got 25%? Well, that's going to do more than the life insurance. Well, sure, you're going to be able to do that with all your money. What's going to happen when that real estate thing goes sideways for a little while? You're going to have cash to support that, right? Well, so where is that piece? Well, I would have some savings for that money. Oh, exactly. what, at 0%, 0.5%?
Yeah.
Or would you rather do it in a life insurance policy that has a way better rate of return and has a death benefit and other pieces along with it that can make your strategy actually work out, right? And so it's that bigger picture and understanding where it is. And something along those lines that you and I talked about was the idea that with a life insurance policy, we're really looking at net, 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 right? When we look at the returns, and so often what happens in the industry is everybody wants to compare gross of another asset before any fees, taxes, all those other costs against the net of a life insurance policy. And it even is, I think, bigger than that because what we're typically looking at with a life insurance policy is some of the minimums that we can expect from the life insurance policy. So, in other words, when we look at a life insurance ledger, that assumes we park the money and there were no black swan events that ever happened that the life insurance helped us get out of. There were no opportunities that came along that the life insurance helped us take advantage of because we have access to that cash. It's a whole different scenario of what that impact on our financial stability and future can look like over what other assets, because most other assets, and I usually use the or and aspect there, most other assets are or decisions. I can put it in real estate, or I can put it in the market, or I can put it here, et cetera, et cetera. And it's because once it's in those particular assets, the only way to get to the use those dollars is to liquidate the account, right? But with life insurance, it's an and asset. And when we look at what it does on paper, we're looking at minimums because we also have access to that cash, right? We could use that. So we could put money in the life insurance and still put it in real estate, right? Or other places. So there's twofold there on how the importance of understanding what those returns look like. And it's a difficult thing for people to see if it's a 2-second conversation, right? We have to go deeper. We have to look at what's going on. One of the things that I've come to recognize is that, a lie can be told in one sentence, but it takes a chapter to explain the truth.
Isn't that what comes to mind, right? Is using your calculators and presenting some of this stuff to clients, right? Is I think typically we get away from it, but it's not a simple answer, right? Is there's an education process that you're walking somebody through, and it can, as you go through in the learning process, using a borrowing strategy calculator, right? That could be a 15 to 30 to 45-minute conversation pretty easily, right?
Right.
Instead of just telling something what to do. So great point. Another one of your lines that I've often used, and I'm looking for a little history on this one, is there's no deals in life insurance. Give us a little background on that.
Yeah. So when we look at the financial industry as a whole, like I said earlier, the competition for life insurance is just about every other asset that's out there because life insurance, when you really understand how it works, it's a phenomenal tool. And it's not all just about tools, it's about the strategies we used around them and the other pieces, but it's so flexible and there's so many things that we can do, it makes it hugely beneficial. But the insurance companies, they're not smart enough in a lot of ways to fight against or where the competition really is. Instead, they're fighting among each other. Oh, our dividend was better this month than yours was.
Yeah.
Last year we had a better, it's like, come on, guys. It's all this, it's the same thing. And that's what it comes down to. There's no deals in the insurance industry. And what I mean by that, it actually stretches out beyond just life insurance. It's in all insurance. It's in P&C insurance, right? Everything is about a trade-off between risk and cost for the insurance company, right? And so if you find a deal where the premiums are a lot lower than other places, then the insurance company somehow has shifted risk. And so let's look at an extreme example for a minute. Why is term insurance so cheap?
It's very little risk. Someone's
Right.
healthy, young, they're not going to die. They've done the underwriting. Yeah.
Right. And they can't keep it, right? It's going to terminate before the risk actually keeps in. In other words, what's your likelihood of dying before 65, let's say? Pretty small. What's your likelihood of dying after that? 100%.
Yeah.
Okay. So whole life insurance is a lot of risk for the insurance company. Why? So the premiums are higher because it's the right way to do it, right? Why insure during the time? I'm not saying don't do this. So let me clarify this. We need to be insured. But I'm just saying, really, we ought to be insuring after 65 more so than before. And because then it's guaranteed to pay us out, whereas term insurance is the opposite of that. We're paying for it during a time the likelihood is low, and we're getting rid of it when the likelihood is higher. And so, I think that's by design. Again, it's one of the lies that's put out there. Oh, you only need insurance during the time that you're working.
Right on.
Right.
Todd, yeah, in regards to kind of that risk aspect of it, I think a lot of times that is overlooked when people are assessing whole life versus IULs.
Yep.
Could you maybe enlighten us a little bit? And maybe enlighten Anthony, right?
I was going to bring up IULs, but
You think he's smart
Oftentimes,
enough to handle it?
yeah, I don't know if he's. I don't know.
Man.
I'll educate him later. But,
Todd, if you remember, we talked early on that we're keeping track of the zingers you give. Half a point on me, well, a full point
Yeah,
on Cameron.
that must be
Yep.
CPA math there because it's not fair, right?
Man, you're like, man, you have 0 on Cameron. Okay, all right. Sorry, go ahead.
a lot of times I see whole life proposed, right? Or IULs are proposed as, the same thing as whole life, but half the cost.
Right.
Right. And I think they overlook that risk piece. So I was hoping you could touch on that.
Sure. It's that just it cannot be, and you're exactly right about what the verbiage is. Again, a lie is told in one sentence, right?
Yeah.
Same thing as whole life for half the price. Well, you have to dig into the illustration to see where all those pieces are, and it comes down to the guarantees. And here's my take on it. So, what does the word insurer mean to you?
Safety.
Yeah. How about to make sure something happens, right? And
Yeah.
then what insurance is. And so,
Yeah.
why would you have risk on what you're calling insurance? It doesn't make sense to me why it wouldn't be guaranteed, right? And so when we're talking about insurance, to me, it ought to be guaranteed. That's what the word really means, right? And yet we don't have that with the IULs. And if you'll look at it, and it's not the I part of UL. So, and what I is indexed UL, but what happened in the UL industry, the universal life industry, was it started with interest sensitive universal life. When that stuff kind of started coming apart because it was minimally funded and some other things that were happening, they moved to other pieces, investment type of universal life where you could put it into the market and play with those pieces. When that stuff started coming apart, what did they do? They went to index universal life. It's still all built on the same universal life chassis. It's just the crediting was changed through those various iterations. And so we still have the same product. And the idea is, so let's go back to what we were talking about that permission slip of being able to spend money because we know something's going to happen in the future. And that changes the strategies that we can use to be more efficient around the other assets that we have. Well, we can do that with whole life because it's guaranteed to pay. Right? And if we outlive it, it's guaranteed to pay. What do I mean by that? Well, it endows, right? Currently at age 120, if we live past that, then they're going to pay us that money. So it's going to happen, even if we don't die. But a UL policy is never paid up.
That to me, well, man, there's a lot of risks with the IULs, but the ability to never pay it up, meaning no more premiums are required and it's not going to jeopardize the policy itself, is such an important issue.
Yep. And so not only is that at the end, which to me is one of the biggest issues, along the way, the guarantees on the way they can move around the investments internally to make it work for the insurance company. So if they've got half the money is all they have, then they're having to push the risk off in other areas. And they're doing that through participation ratios. And what that means is, like, if it's based on a certain index, the earnings, it might be a percentage of that earning instead of the whole amount of the earnings. There's caps in there on what the top end is. In other words, if the index was showing a 15% return, they might have a cap at 8 or 9%. So you don't get to take advantage of the high side. And they do it by saying, well, you don't also have to take advantage of the low side. But I don't think it's worth it for the trade-off. And again, it's insurance. It ought to be guaranteed.
Well, Todd, you know what? I don't care about the guarantees. I don't care about the death benefit. The IUL is going to grow with the stock market, and that's going to bring me more money that I could use as tax-free in retirement.
Then what I would say is here's my thought.
Mm-hmm.
That would be to buy whole put money in the stock market and buy whole life. No. Difference, right? No, but really, why have the UL? Why not just have term insurance? And here's my thought on it. Is there a traditional need for the death benefit during the working years?
Yes.
Yeah, absolutely. Right. We have to protect. What happens if something happens to us? Do we not want our kids to still go to the schools we had planned for them and all those pieces? So at a minimum, we need to be replacing our income in the unlikely event of a premature death, right? It could happen. It happens. Okay. So we need to cover that. But beyond that, and let's say we were planning on retiring at 70, if we have a tool that will cover us until age 80, is that helpful if we were going to retire at age 70?
Yeah.
To me, it's not helpful. If it won't go all the way, then really all we need it to do is cover our income. And with UL, it's like overpriced term insurance.
Yeah.
Right? It extends it out a little bit of time, but it's not going to make it to the age that you die, or you can't guarantee that it will. And so if it's not going to go all the way, to me, term insurance is a better option.
Now, in regard IUL, it seems like it comes in waves where people are all hot and heavy about IULs, and then it subsides. And right now, it seems like there's a wave of people bringing it up. We're not fans of IULs, and we have the information to back it up. On our website, under resources, there's a tab why we don't recommend IULs. So in there, we compare a whole life policy, IUL policy. We have some white papers. There's some, I think, that was done by Todd Langford as well. But we want to educate. And if you want to learn more from that fence in the IUL, very important for you to know the pros and cons. So I'd recommend that you check that out.
Yeah. And what you said is exactly online. That's the biggest piece, is that just don't accept it from somebody who's selling it. Either one, look at it yourself, dig through the front end of those illustrations and see where the guarantees exist and where they don't, and investigate it for yourself to see why. I just personally like the whole life insurance, knowing that the guarantees are there, right?
Speaking of figuring out for yourself, Todd, is Anthony and I use your calculators, right? I think I use your calculators every day, right? But what I think is great is that, man, anybody can go right to truthconcepts.com and really buy the software for themselves and go play around in it and figure it out, right?
Oh yeah, actually they can download it for 30 days and play with it for free. So
yeah.
Yeah.
Awesome. If they go to truthconcepts.com, what else will they find?
The blog has got some great information in there. So if they'll look at those pieces and go through the blog, there's a lot of ways to answer, a lot of questions that people have. How do interest rates really work? And that's something that's really not understood. And it goes back to the time value of money issue in a lot of ways. People think you can add and subtract interest rates. Well, they don't work that way, unfortunately. And so if they did, banks wouldn't have any money. Right? But it's good for the banks that people think you can just add and subtract interest rates. So it works well for them.
Well, Cameron says he uses your software every day. I use it every day and at night. Okay. So twice on Saturdays, but
Todd, thanks so much. Again, we really appreciate you being a resource for us, and then we enjoy the opportunity to kind of highlight you in front of our audience and see if they can reach out to you in any way or start following some of the content that you guys are putting out. So thanks again for coming on.
You bet. I really appreciate you guys too. I love what you're doing in this field and the fact that you're helping generations and generations of people, right?
we love what we do. Very passionate about infinite banking, as you are with the math. So Todd, thanks for coming on. We appreciate it. Go make it a fantastic day.
Take care.
Thanks for listening, and be sure to subscribe so you don't miss out on the next episode. Also, check out our website, infinitewealthconsultants.com, to find our podcast along with other additional resources.